Hey guys, so Justin asked a question a little while ago on real estate investment trusts versus stocks and sort of which has a higher return on investment in the long run, sort of taking into account capital gains, tax issues you may have with them, and dividends and everything. So I thought that was an interesting video to look at. So if you take Realty Income as an example here, sort of one of the most popular US REITs, and yeah, so they're a trust that own sort of 11,280 commercial properties, very much sort of full occupancy most of the time, 70 different industries. You can take a look at sort of their top 20 clients. It's large companies, multinational companies, sort of FedEx and Walgreens and that sort of thing, Tesco's, getting into the UK a little bit also, sort of Tesco's, Sainsbury's, sort of various different companies. So if you look at, say, Yahoo Finance, a lot of the sort of normal stats that you'd be looking at on their sort of statements wouldn't make sense to a normal sort of company you'd be looking at. So it's yeah, $41 billion market cap. Fair enough. The dividend yield is going to be sort of broadly accurate. But when you start looking at sort of analyst expectations and that sort of thing, this is going to be earnings per share, which is not really accurate for a REIT. So $1.46 in earnings per share sort of gives it a very high PE, but that's not really the sort of metric you want to be looking at. And yeah, looking at sort of financials and that sort of thing, net income again isn't the sort of metric you want to be looking at with REITs. They're just a little bit different. So explain why. So funds from operations. So the net income of a REIT isn't particularly useful because they sort of deduct before getting to that net income quite a large amount in depreciation and amortization of properties, which is not really sort of a realistic view of their income, particularly. Properties obviously don't depreciate like other assets would in another company. So generally for REITs, you want to use this sort of adjusted net income, essentially. They call funds from operations. So you add back depreciation and amortization once getting the net income, and also any you want to sort of net off any losses or gains on the sale of assets, because that's a one-time event. So yeah, Investopedia sort of show you a little calculation for that here. You can do it yourself on something like sort of Yahoo Finance, or probably go into their own company statements, and yeah, that'll give you sort of funds from operations. And also you can have adjusted funds from operations. So this goes a little bit further and sort of adjusts for capital expenditure and sort of maintenance costs as well, and also adds in rent increases sort of for the next year and the past year. So calculation would be sort of the original funds for operations, adding on the rent increases, and then taking off your sort of annual maintenance and sort of capital expenditure allowances, because it doesn't happen every year necessarily. You can sort of use either really, but if you can get adjusted funds from operations figures, then it can be a more sort of realistic way of measuring them. So a useful site for certainly US REITs is Seeking Alpha. Actually, a lot of people sort of don't really notice that they give you this sort of very little useful section, sort of a brief summary of REIT specific forward estimates. So they give you a forward estimate of funds from operations, where sort of your Yahoo analysis and that sort of thing will normally just give forward estimates of EPS, which is not useful obviously for REITs. So if you go to sort of Realty Income, it'll say it's got a price to earnings of 70 odd and a forward of 40, which isn't particularly useful. So yeah, you go to sort of Seeking Alpha, they'll give you the funds from operations forward estimate of $3.99. So that gives you a price to funds from operations, which is essentially your equivalent of price to earnings of 17 for Realty Income, which is quite useful. They give you sort of dividend rates as well, and the yield, and sort of how much it's being shorted as well. It's quite handy. So yeah, just nice to have that little sort of little section. You can compare it to sort of other REITs. Say take American Tower, sort of cell phone tower REIT. They'll give you sort of $10.43 funds for operations, obviously on a larger share price, so people are more bullish about the growth of American Tower. So they get 24 forward price to FFO, or sort of price to earnings equivalent. So a little bit more premium than Realty Income at 17, and you do also get a lower yield with American Tower as well. So they can maybe sort of make some adjustments in their accounting, because they do have to pay sort of 90% of their earnings out as a dividend, but they may be able to sort of slightly fiddle the figures to sort of keep this dividend fairly low, and yeah, it could just be people paying a little bit more for the stock that sort of keeps the yield low on how much they are able to pay out. So yeah, Seeking Alpha is quite handy for the US ones at least. So the US REITs seem to sort of put this FFO and AFFO number sort of fairly front and centre on their results. So look at Realty Income, they announced their latest quarterly results, and they'll sort of tell you net income first, which is kind of useless, but then normalised funds from operations of $1.02 and sort of adjusted funds from operations of 98 cents. So they sort of give you that quarterly, where the UK ones sort of just seem a little bit more cagey on it, so you'd have to dig into their results and work it out for yourself. And yeah, they give you sort of stock price and dividend rates and that sort of thing. So as far as returns go, certainly for the US at least, a lot more tools sort of make it easier for US companies. You can use Portfolio Visualizer, which is sort of one of my more favoured websites, and yeah, you can sort of go insert sort of 3 tickers, for example. You can have more if you like, but just to make it easier, you sort of put 100% in 3 different portfolios. I've used Simon Property Group here, Realty Income, and an S&P 500 tracker, and you can sort of say sort of from the earliest that it'll allow, invest $10,000, but reinvest the dividends. So you could sort of do this elsewhere and just compare the price graphs, but this will show you sort of if you reinvest the dividends annually back into the company, it sort of compounds those as well. So it gives you a proper sort of portfolio analysis. And yeah, so so Realty Income, for example, it's only got data back to 1994, so that's the earliest that it'll go for all 3 to make the sort of comparison a fair comparison, basically. So it'll give you the chart here and your sort of figures. So Realty Income gives you an average 14.8% return. Obviously not going to get that every year, but it's averaged over that time period, so sort of 28 years. Simon Property Group 11.56%, and the S&P 500 10.33%, all including dividends reinvested. So you can see on the graph here as well, sort of S&P did quite well going into the .com bubble, and the REITs were sort of underperforming slightly, but then sort of went up again going into the sort of 2007, 2008 housing bubble, and sort of came right down. Simon Property especially, and yeah, sort of recovered, still outperforming the S&P, coming up to the 2020 crash. Obviously, Simon Property, if you don't know, is more a sort of industrial, not really industrial, sort of commercial property, a lot of shopping malls and that sort of thing. So obviously they were all shut during the pandemic, so it took a hell of a hit. Realty Income, sort of more shops that stayed open, and yeah, they did a little bit better. So yeah, you can just sort of see, you can choose to sort of start this later on if you like. So you can say sort of start from 2004 instead of 1994. Go to analyze again, and it'll give you different percentages for all three. So Realty Income still is the winner on that. Simon Property Group slightly outperforming the S&P, and then the S&P along the bottom. So yeah, it's quite a useful tool, and quite good for sort of comparing not just REITs but any US stock really. They'll give you sort of ADRs of UK stocks, so you can put like Shell for example. It gives you the US listing of Shell, but you can't really get any great deal of UK companies. You're not going to get say Tritax Big Box, the sort of UK industrial one. So yeah, really good for sort of just US only companies really. And just as another comparison, I've thrown on a couple of my sort of favoured REITs, Digital Realty Trust and American Tower. So sort of specialist REITs, Digital Realty in the data centre space, and American Tower on sort of cell towers. And yeah, against the sort of S&P, did sort of reasonably well going into sort of 2018, 2019, but then have started to sort of pick up more sort of interest in these specialist sectors, sort of data centers obviously growing and growing as the internet grows and more sort of storage required, and yeah, the sort of 5G push in cell phone towers. So yeah, this obviously again is all including reinvested dividends, so it can sort of show you your overall growth. If you again invested $10,000, you can sort of get your final balance that you would have ended up with since sort of the beginning of 2011. And yeah, sort of average yearly return. Again, you're not going to get it every year. Obviously, you get large drops mid-year and year to year, but that's your average. So for UK REITs, it's a little bit more difficult. Trick you can do is go on Yahoo Finance and sort of pulled up Tritax Big Box for example here, and it'll give you sort of market cap and dividend yield and that sort of thing. 3.39% for them. It's not too bad, but if you click on the charts, you can compare sort of prices going back sort of as much as you like, sort of manipulate the dates here and sort of time wise and that sort of thing. And so I've thrown on, you can click on comparison and sort of put on other indexes and that sort of thing, or other companies, other REITs for example, or stocks. So I've thrown on the FTSE 100, the FTSE 200 in green, and the S&P 500 in yellow. So compared to sort of Tritax Big Box, the FTSE 100 and 250 have not done too well over sort of the last 5 years, for example, and the S&P has sort of outperformed quite well. Obviously, the S&P has a lower dividend, so you would add on a fair amount sort of to the Tritax Big Box for sort of compounded extra couple of percent return every year. So Tritax would probably be a little bit closer to the S&P, but you can sort of scrub back the timeline and sort of go before the pandemic crash, for example. So this was that's sort of as far back as that wants to go on this time frame. But yeah, so from sort of beginning of 2014 to mid 2019, it's a little bit more sort of spread out. FTSE 250's done a little better. FTSE 100 still dragging along the bottom. Tritac's done quite well. Had a little drop, at the end there, and S&P sort of still on the top. But as I say, with sort of over 5 years of compounded additional dividend, Tritax would probably be up there pretty much sort of with the S&P. So yeah, a little bit more difficult, less scientific than with the US REITs. But if you really want to, you can sort of do the maths yourself, work out the dividend each year, and put it on a spreadsheet, for example. So I mean, you can throw in other REITs here if you want. So take something like Big Yellow self-storage. Never really understood this one, why people need so much self-storage, but that's done quite well. I think it's even outperformed. Yeah, it's outperformed the S&P even over that sort of time period. So people don't have enough space in their house or garage or whatever. So that's done quite well. So yeah, that's quite handy for sort of any company really, not just UK, but if you want to sort of compare REITs, certainly. And so tax-wise, this is sort of part of the reason they're not all that popular in the US, because the US don't have ISAs. They have their sort of equivalent, the IRA, or Roth IRA, I think it is, but it's just not as good. The ISA in the UK will sort of exclude you from any capital gains tax, dividend tax, or any of that. Even REITs in the UK, if outside an ISA, would end up partly getting charged as income tax for a lot of them. Some of them will sort of have split amounts that would be charged as dividends and some as income tax. So it's just very, very complicated, but have them in an ISA and they are very good, no tax at all. So they, because they pay out 90% of their income as a dividend, they actually don't have to pay corporation tax. So if you have them in an ISA, they're not paying tax, their company isn't paying tax, and then you don't pay any tax when it reaches you. So I always call it sort of a double win, almost cheating. So REITs in the UK in an ISA are quite an advantage. And so because they have to pay out 90% of that income as a dividend, it's quite difficult for some of them to expand. So you'll often see them sort of diluting shares a lot more than sort of ordinary companies would, and that'd sort of normally be seen as a bad thing for normal companies. But with REITs, sort of, they're diluting to buy another property, for example, or their sort of alternative is taking on more debt, really. So you can sort of look at sort of how much debt they've got and sort of whether you'd be happy with them taking on any more. But often it does end up as sort of diluting shareholders. So really, you would want to sort of look and see whether them diluting and buying another property is going to sort of be an overall gain. So it may be sort of whether they're getting a higher yield on the property, and so you'll often see this word accretive. So if they're announcing sort of dilution to buy something else, so Realty Income, for example, sort of done a deal with Wynn Resorts to sort of take on some of their properties, and they're sort of saying this will be executed at a 5.9% rate. So they would say that is accretive to earnings per share because they're issuing more shares. Obviously, earnings per share without them buying anything would come down, but because they're spending it on more properties at 5.9% rather than the 4.4% average that they currently have, the sort of dividend amount per share would be going up. So they're essentially saying this deal would be worth the dilution, basically. So you're getting diluted, but they're spending it on higher income properties. So yeah, that's the sort of the phrase that you'll see a lot with REITs, whether if they want to expand, is them expanding sort of worth it to the shareholder, basically. And I guess one final thing you can look at is probably something like macro trends, the sort of assets and liabilities and sort of net income, sort of long-term history, again, aren't going to be all that useful because they're sort of diluting, obviously, per share. So you'd expect revenue to go up and sort of assets to go up. It's not really telling you sort of any sort of return that you're going to get. But the dividend yield obviously stays sort of relevant. So you can look at sort of long-term yields. Realty Income, for example, has sort of come down over the years as people sort of like the company more and more. They're willing to pay a little bit more for that sort of stable income. But yeah, you can sort of show sometimes the yield goes up. The sort of March 2020 crash, the price come right down. The yield went up to sort of 5%, and yeah, you can sort of think maybe if you thought they would still sort of keep their tenants and they wouldn't be losing income, then you could have bought it at a reasonable rate there. You can sort of bring this forward, obviously, a little bit and sort of maybe use this as a metric. If the sort of dividend yield goes up beyond sort of historical amounts, then could be a good buy. But yeah, it's a little bit sort of more difficult to get useful metrics with REITs, but that can be a little bit useful. So yeah, that's pretty much it for REITs. Hope you guys find this helpful, and yeah, like and subscribe. See you soon.